1/3 of Canadians didn't save a dime for retirement last year.
Wow.
So that is, yeah, and it's a big
Wow.
number when you think about that. 1 in 3 Canadians just simply, didn't put any money away. And that's going to be a big, structural issue per se, or can be, because, at some point we all have to retire. We can't work forever, even if we wanted to.
Hey everyone, welcome back to the newly rebranded Hustlers Mindset podcast. I'd been meaning to make a short video about this earlier, and unfortunately I didn't get the time to do that. I wanted to quickly just explain, in case people are wondering what happened with the name and why is it not the hero's journey anymore. And the reason why I had spent some time thinking about the podcast, and as much as I love and have enjoyed hearing about people's journeys, I also wanted podcast to kind of expand and be able to talk about different topics such as financial literacy, or joining a startup or starting an online business. I wanted to kind of be able to talk about different topics and the mindset that it kind of takes to kind of be successful. And to do that, I felt like the name kind of needed to be a little bit rebranded and a little bit more of a focus. So we still will talk about people's journey from time to time wherever that is appropriate and makes sense, but I wanted to kind of open up this kind of the world of possibilities of what we could kind of talk about and kind of sharing knowledge. And along with this rebranded podcast name and focus, I do have a companion LinkedIn newsletter of the same name called the Hustlers Mindset Newsletter. And I put out a newsletter every week on LinkedIn, and I'll leave a link to the show notes for that one. And the goal of that is really to give you actionable tips each week to develop a growth mindset and to help you kind of design the life you want, starting from where you are right now. If you find the podcast valuable, I'd love it if you could rate and review, as it helps more people find the podcast and access this information. And so with that, we're going to move on to today's guest and topic. Today, we're going to cover the ultra important topic of financial literacy, which is something a lot of us have never really had the opportunity to learn, perhaps during school. And it's such an important skill and such an important mindset to develop. A lot of people that you see around you that are wealthy, financially independent, successful, they've developed their financial literacy often at a younger age, and if they've given themselves the time and benefit to kind of grow their net worth and acquire assets and liabilities, which we'll go into a little bit later on. And so the goal of today's episode is really to help you take that first step to increasing your financial literacy, along with giving you some resources that you can follow after this episode to kind of continue on this journey. And with that, I want to introduce today's guest, Brian C. Brian has over 15 years of experience in finance, investment, and capital markets experience, spanning bank-owned dealers, pension plans, family office, energy, and logistics. For over 7 years, Brian has served as vice president at CIBC Asset Management, where he was the lead portfolio manager on 3 standalone global investment products. In his current role, Brian serves as the Chief Investment Officer at Evermore Capital, which is Canada's first ever target date fund ETF that helps all Canadians simplify their retirement goals. We'll talk more about target date funds a little bit later in today's episode. Brian, I appreciate you so much for taking the time to come on today and speak with us.
Happy to be here, Vishaal. Thanks for the invite.
Yeah, my pleasure. We've talked a few times, before with, my own personal investing journey and asking for advice. And I couldn't think of a better person to have on here. So let's jump into this. We have a lot of stuff to talk about. So I wanted to start by asking you, like, in your 15 plus years of experience working as a CFA in finance, investing with clients, what have you observed in terms of overall financial literacy, especially in younger age populations?
Yeah, it's an interesting question to determine literacy amongst the broader population. But I guess in my experience, and this is just anecdotally observing, financial literacy could certainly be improved in Canada from what I observe. I mean, it's such an important aspect, and I think you touched on it in your intro that a lot of people aren't educated about it, and so with that, it leads less and less knowledge. Um, when you kind of take a look at it, and I was reading, certain reports out there, whether from StatsCan or other nonprofit organizations, the literacy rate in Canada is it's not as high, or could be higher. I think anywhere from 60%, 70%. But you would think it should be even possibly be higher in more developed nations. And so, with that, there's many areas that can be improved as we kind of go forward. And then we can talk about a lot of those, but I think I'd leave it at there for now.
Yeah, absolutely. It is interesting, and it's good that you mentioned that number, 60 to 70%. That is an interesting number. I didn't actually know what that percentage was, and I think definitely there is definitely scope for it to be higher for sure. And from your perspective, like, what about like especially younger people? There, from when you've spoken, their mindset towards their idea of saving, investing. Like, do they care about saving and investing?
Yeah, the whole saving and investing concept, particularly young people, I mean, that's also challenged as well. For one, I think it goes to the fact that, why don't they do this as much? And I think it comes back to the school system. I mean, when you look at grade school, financial literacy or saving and investing, it's not exactly taught. I mean, you grow up going to and studying the regular courses like math and science and language arts and so forth. And that's all great, but the investing portion often gets left out and becomes a really important aspect of our lives as we grow up and get jobs and have families and so forth. And so I think for one, why it's low to begin with is it's just simply not taught in school systems, and you often have to often either self-educate yourself or have parents that basically end up teaching you about this. Otherwise, it can kind of be quite daunting and difficult. So I think that's one thing. And then maybe the second thing is that there's just so much information out there. I mean, it's good that there is a lot of information on financial investing and saving and planning. There's always some new strategy or product or someone telling you about a hot new tip. And that's great, but then sometimes it can get overwhelming. And then I think a lot of people just get confused and often just move on to other things. So I think those are probably two reasons on why it's driving a lower than lower, I guess, financial literacy rate.
And the other thing I'd add to that is when you talk about the getting overwhelmed part, then the flip side is you get overwhelmed, so you turn away, and then you go on to social media, Instagram, where you have like the whole flex culture and like showing off or like buying things or the cars. So you see that. So it's like, well, that's something I understand. If I just have the money, I can go and get that. Right. It's just a simple of take the money, buy, or take a loan, get it, and do that. That's a little bit easier to maybe understand. And that flex kind of culture, and you do that. And then you kind of, you can get stuck, but that's maybe a little bit easier to understand. And that's kind of what led me to my next question about spending habits. Like, it's very fascinating. Are people today trying to, they're working more? Are they working and saving more? Are they investing? Are they leveraging that? Are they doing a little bit of both? I think it's a very interesting kind of topic to see how are young people, what is their mindset towards work, and also what do they do with that money that they make.
Yeah, and in terms of it certainly feels like we're working more to have less nowadays, especially with inflation rates that we're seeing today. So I think we can all relate to that. I mean, that's a big level of inflation we haven't seen since the 1980s. So that's definitely being felt across the entire country and all Canadians' pocketbooks. Just trying to quantify some of this. I was reading Hoop Pension Plan's latest retirement survey. They put out this annual retirement survey, and then I follow it as well, just to kind of get a sense of where they are in terms of Canadians. But here's an interesting statistic that 1/3 of Canadians didn't save a dime for retirement last year.
Wow.
So that is, yeah, and it's a big number when you think about that. 1 in 3 Canadians just simply didn't put any money away, and that's going to be a big structural issue per se, or it can be, because at some point we all have to retire. We can't work forever. Even if we wanted to. So, and some of the reasons they actually cite that is, again, probably comes back to inflation, is that people simply live paycheck to paycheck. And that's really going to, obviously impact people's financial situations and ultimate financial goals. And so that's going to be a bigger thing. And it's even more prevalent in the younger population, which they define as, 18 to 34-year-olds.
It's really fascinating that you mentioned the paycheck to paycheck, because now I'm thinking back to 2020 when everything shut down and people were it was very shocking when we realized how fast the US had to pretty much mail out checks to people, even in Canada too with the CERB. It really showed how many people in Canada and the US actually were living paycheck to paycheck, because when the money stopped or temporarily just for a little bit, a month or two, you were just kind of leaking oil. You were already in trouble.
Right, of course. And then that was a temporary thing where you had money, and most of that money, went to online shopping. I think a lot of people purchased goods, and you saw that in companies' financial results, which sales were extremely strong, and people actually ended up, investing a lot in a variety of investments, some good and some bad as well. So there's all these, I guess, what do you call it, unintended consequences from government sending out checks to people.
Yeah, there absolutely, some people took that money and they actually paid the things that they had to pay. Some who, if they got a little bit of a surplus, they maybe invested that and put that somewhere, and some went and bought the latest, purse or something else, whatever they wanted. And it was like a little bit of a spending spree for them, right? So it's again, it's kind of where the mindset of where they were at. And going back to what you're saying about the 1/3 putting it, I wonder whether that was that like maybe a COVID thing of like people were just like, hey, I just want to live for the now. I don't know what the future is going to be. So just what the hell about the future? I'm just going to live for the now. I wonder if the COVID situation just made a certain percentage of people think that, hey, who knows what's going to happen in the future? We've already seen this happening. I'm just going to live for the now.
Yeah, and there's certainly a lot of that happening, and especially in the last couple of years, in what we've experienced with COVID. But I think it's also almost something that's been a challenge for many Canadians over the years, even in a pre-COVID environment.
Mm-hmm.
Another study, and that I was looking at was BMO, was analyzing what was held in TFSA and RSP accounts. And so, even if people are saving and putting it into these vehicles, what exactly are they buying? And what I found really interesting on that is in your TFSA, which is a tax-free savings account. So all the returns you make in those accounts are 100% tax-free. However, half of that TFSA was held in cash and GICs.
Mm-hmm.
So, when you think about that, you say, well, cash and GICs barely return anything.
Right.
Now they return a little bit more just with rising interest rates in today's environment, but historically they didn't giving you much return. And in RSPs, that figure was improved, but it wasn't that much better. It was 34%. So 1/3 was just held in cash. And what this ultimately means is even the people that are saving, that's just being held in cash securities, and that's being eroded by inflation year after year. So you're not exactly getting ahead. Yes, it is good that you're actually saving that money, but the reality is that value of that dollar is being eroded over the course of time. So I found that also quite interesting as well.
It's very fascinating. And speaking of just of that, I was going to take you into the next thing I wanted to ask you about was, what about the advice that banks are giving to people regarding what's best for their money? Is this can you tell us a bit about the advice that the banks give, and is this really good advice that people are getting?
I think you always hit it interesting topic on there, and people's opinions toward banks. And I think we've all had our fair share of experience at banks. But look, I would say that I think most Canadians have been in a bank and have probably at one point or another spoken to a financial rep at a branch, right? And so, look, it's not a bad place to start if you want to understand, the basic things like setting up accounts and what kind of products they offer, and should I set up a savings plans and so forth. I mean, I can remember early on, when I was 18 years old, I walked into a branch and started just learning about this for the first time. So it's not a bad place to start. I think the one thing that you have to understand is banks are businesses just like any other business, and they've got to make profits. And so they've got, incentives to make profits, and that might, be involved with selling their own products. And so you have to see if those line up with your goals as well, right? It's your money, so you have to understand that. I think, at the end of the day, you got to understand a few things, like banks, whatever bank you go into, they're probably going to be selling their own products, and rightfully so. I mean, that's what they're in business for. So you have to understand that you're not seeing the full suite of investment products per se. You're just seeing that banks, and And there is a lot more products out there that you could find. You could probably find others that are potentially cheaper or ones that maybe fit your goals better. So I think I would just, caution people in that, and that really understand that, the one thing that banks can help you with is they can help you set up a direct brokerage account as well, which is, your online direct investing account. And that way you can take charge of your investing journey as well. And so, that'd be the one thing I would comment on banks. The other one is, I know a lot of people talk about financial advisors. These are the people that would, help you, but you often have to come with at least, anywhere from $500,000 to $1 million in cash assets for them to help you invest. And then they charge you a percent, fee on the AUM that you bring them, or the assets under management. And so that's all great, and you'll get other services like tax planning and estate planning and so forth. But again, you have to bring a lot of money, and I think for most Canadians, they don't have that disposable income ready to go.
It is, yeah, it's a difficult one. And I was looking at the difference of, like, I had looked up, I think, as myself, but I was doing my own reading from in the past of, like, financial advisors and looking at that. And when I go to their website and you look at, okay, you want to arrange a call, and they'd have a section like, well, what is your kind of net worth? Like, how much are your investments kind of worth? And I think the lowest one started from, like, I think it was like $500,000.
Yeah.
Like it was $500,000. And so you can't, there's nothing else to select. So you can't have a call with them. You're not eligible, right? They don't have anything, for you in that sense. And speaking of that one, like when you talk financial planning and a financial advisor and planner, kind of what would be the main difference between those two?
Well, I actually use those terms synonymously or interchangeably, to be honest, because terms are always changing at banks, titles are always changing. But the reality is this: I think when you walk into a bank branch per se, or talk with someone on the phone, whether they're called financial advisors or planners, they're probably the ones, that are just going to be, pitching the bank product to you. If you don't have that $500,000 threshold to meet and to talk to an actual financial advisor where they charge you a fee on the amount of money, then you're just going to kind of get the basic plain vanilla stuff that everyone else would get, right? And so there's really not a whole lot of difference. I think it really depends on the assets you bring. The more assets you bring, the more customized services you bring, and then you can start to getting a lot more value added. Of course, it comes with a fee. They'll be able to sell you stuff outside of the bank branch network and a lot of different other funds. But again, you have to come with the money, and so I would say that is really the key difference.
Yeah, that was something I was confused about myself. So I'm glad you cleared that up. And going back to the bank ones, I think you're right. Like they're naturally inclined to sell their products, and it's kind of, what's in their kind of best interest. And at the end of the day, and we'll talk about this later, is if you already have, if you have something invested, let's say with the bank, regardless of what those products are and fees, I mean, that is still better than completely nothing and just having money kind of sit in cash, because like you said, inflation is bringing that down. The $100 you had last year, what you can buy with that, you can buy less with that same amount this year, right? So it's just
absolutely
eroding, right? So it's like you think that, oh, my money's there, but it's just you don't really see that it's value, because you just see it as $100, but you don't see that the purchasing power has gone down,
right,
with that money. And so it's can't that apple maybe you're picking up 2 apples, and now it's like you'd only get like maybe like 3/4 of that apple. You don't even get about with 1 full apple, right? So it's just kind of eroding all the time. And the other interesting thing, because I like to listen to talks on YouTube and TED Talks, and there was a speaker, I don't know if you've heard of him, I think he's called Wall Street Trapper is what he's called. And he he grew up from he spent about 10 years in jail, and during his time in incarceration is kind of where he learned. He said, I self-taught myself about investing and financial literacy. He said, I spent time reading the newspaper, and that time obviously there wasn't probably the internet or like things that we have access to now. It was a lot of stuff was in the newspapers. And so he was talking about that, and he's like, and he kind of gave an interesting analogy, and I found it really interesting. He was talking about like the financial, like these institutions, or they call them financial predators sometimes, like they can't really teach other people these things because it's not in the best interest to teach them these things. Right. It's not in their interest. And he kind of gave this analogy of like he said that the lion can't teach the zebra how to get away. If the lion teaches the zebra how to get away, the lion's going to become a vegan. It's not going to have any food to eat. And nothing wrong with veganism, but it was just a funny analogy. Like he can't teach them can't teach it that stuff. Like they need to have consumers. They got to have people who are
Right.
going to be doing this thing. So they can't give you all that knowledge, but you can get that knowledge, but they don't necessarily want to give it to you, directly and be.
That's right. That's right. No, it totally makes sense. Again, it comes down to incentives, right? Well, I mean, they're private businesses just like any other business, right? And so they've got incentive to grow, and that's what they're doing. You just got to make sure that your incentives are also lined up or at least taken care of.
Yeah, absolutely. It was just a funny analogy. It's like the lion is no longer the king of the jungle if he does that. That was the analogy
Yeah.
they give the information. So what about debt? Because this is a big one. And I think people don't always understand like what is the true cost of debt that maybe people don't realize is holding them back from building wealth and also the lifestyle that they want.
Yeah, no. Debt is such a big topic. It's almost we could talk about this for an hour actually, but I don't know if you want to hear about that. But debt. I think people know what debt is, right? It's like you borrow money as an obligation that you've got to pay back with a certain level of interest. And so debt can be it can be an asset or a liability, I guess. And let me explain that. I guess I mean what I also find interesting is sometimes I look up these interesting stats, but debt wise, the Canadian consumer today is actually more levered than they've ever been. And what I mean by that is for every $1.80 of debt, they have $1 of income only.
Mm-hmm.
So it's a 1.8 to 1 ratio. And you say, well, what does that mean in the context of things? Well, that's among the highest in the world. And if you take a look at, say, our neighbors to the south, the US, Americans are actually only levered at 1 to 1, believe it or not. And so they've actually been delivering since the global financial crisis. But I find debt also an interesting thing and how Canadian consumers are at the highest level of debt that they've ever been. But that aside, if we're to take a look at debt now, debt in itself, it's not a bad thing. Yeah, I think you just have to realize what kind of debt you're taking on. And so debt can be an asset to build wealth, or it can be something you're just making high interest payments on. So, a simple example is if credit card debt. I mean, if you're using your credit card to just simply buy, more clothes or toys or gadgets and so forth, and you're not really paying that off, well, the credit card companies are charging at least 20 somewhat percent compounded annual interest payments on that, right? And that's a lot of debt. That's going to be a high amount. That's going to be hard to keep, facilitating month in and month out, or year in and year out. And so that's something that's bad. You want to, do your best to get rid of that debt, pay that down, or transfer that debt to other lower debt investments or lower interest paying investments. On the flip side, there's also what I call good debt. So if you're, taking on a mortgage to buy a house, that is good debt because you're taking debt to build up equity in a home, and so that's a good thing. And that's something that people should be aspiring to do instead of the bad debt. So those are just kind of simple examples when we're talking about debt in general.
Yeah, it's such an important topic, and yeah, I think people don't fully understand, like even just the definitions of things like asset and liability. Asset is something that is bringing, money is coming in, it's something kind of coming into you. Liability is kind of essentially money kind of going out. And you can go a little bit deeper. You're right about the debt. There are, the bad type of debt that you don't really want. Credit card debt. There's also, student debt, things like that. And I wish I'd had this resource in front of me. I was listening to a talk, and one of the speakers had said that even though this is from the U.S. perspective, they said that even though, the United States government talks about how student debt is a big problem and they need to kind of get that down, one of the biggest income markers that the government kind of makes money from is actually student debt. They actually make a lot off of student debt, yet they talk about how much, we got to get student debt this and down, but they make so much money off of student debt.
Yes, they do.
Good for them.
They make a lot of it, and what's also interesting is a lot of the student debt often gets packaged up as investment vehicles and sold out as investment products to other investors.
Mm-hmm.
So in some ways, this facilitating of debt continues because they become investment vehicles that other people own, basically on the backs of students paying debt. And so it is a big problem in the US for sure.
It is a big one. And going back to actually, I missed one, going back to the banks as well. If the banks kind of, when they give their, if they listen to their own advice saying, hey, save your money, put it in the bank, keep it there. They're taking your money and they're investing that money, or they're loaning it out, and they're loaning it out at whatever it is, 15, 16, 18, whatever that percent is, and they're giving you like 0.5,
Right.
0.5%. Right.
Right. Right.
They're actually making huge amounts off your money and growing that for themselves. And they're just giving you like almost such a thin slice you almost can't even see without a microscope.
That's right. And that's something that people maybe are not as aware. I mean, banks are leveraged businesses. They have to go make money. And so they take your money and go and do other things with it. And so again, I think it goes back to that stat that I told you that, a lot of investments in TFSAs and RSPs are just held in cash. So, people should take that money instead of just cash. You could actually put it in investments and earn more returns instead of just taking the small sliver to your point, Vishal. So that they can actually make some returns.
Absolutely. And the sad part is, unfortunately, when depending on, and you were right, you went back to, you mentioned this early on, it's like the ones who maybe the younger ones who maybe started earlier, either they've got exposed either themselves, or maybe they heard it somewhere, or if their parents had known that, they kind of get that edge. If your family or your parents were doing that, they're likely going to get you started on that very soon, or as soon as you are probably legally able to get started. They're going to get
Yes.
you, they're going to get you on that path. The ones who don't, their kids aren't going to know unless, again, they happen to find out from a friend, or they sat on a seminar, or someone at work, maybe a conversation happened and they kind of listened in on it, something like that. They're going to have to kind of find out, maybe possibly through chance in that sense, right? And then
Absolutely.
maybe you've lost 10 years, unfortunately, in that time, right? You missed 10 years of compounding, unfortunately.
Right. Right. And it's interesting you say that. I mean, it is trying to learn that early. I mean, it is a mindset. So it's just like the title of your podcast here. I mean, it is a mindset, because you're not learning that. You have to basically be taught that and be doing this every single day, being disciplined about, paying down debt or investing or whatever. It's not necessarily just reading a couple courses or taking a couple courses and understanding a couple strategies. It's something that has to be, part of your daily habits.
It's absolutely a daily habit. And again, going back to that, it makes me think of, I was listening to someone, the previous one, the same person who talked about, gave the line in the jungle analogy. And he said a really interesting part, and I think it stood out to me. He said that education and information changes the conversation. And if you change the conversation, you can change the compensation.
Yeah.
If you change the compensation, you change the realization.
Wow.
That was a very, very interesting part. And if you kind of deconstruct it, it's saying that, if you educate yourself or you learn, you can basically increase your earning potential, right? You have more, whether that's investing, how people kind of build and generate wealth. You get, if you learn that information, knowledge, however you get it, whether it's a book, a podcast, a mentor, whoever that is, you can change your actual compensation. That realization, that changes your whole life and the way you think.
Yes, absolutely. 100%. And then that's why it kind of goes back to your question about debt. People often think about it's a bad thing. And yes, you don't want to be levered. Obviously, that's a bad thing if you just have the leverage. But if you have good debt and you're using it to build assets, I mean, the home is a great example of that. Just to kind of build wealth. A lot of people are able to leverage the hard assets that they have to build more financial assets and build their wealth, and then basically get themselves to financial freedom faster than a lot of people who don't understand that concept or those techniques.
Absolutely. And going and talking about, like, we heard a lot about, tracking your money, tracking spending. And what are your thoughts on traditional, budgeting techniques, using spreadsheets? Does that way still kind of work well, or are there kind of better ways to kind of track, money coming in, expenses, and kind of how you can kind of maybe live that rich life?
Well, yeah, I mean, this is a great question as well. And I would say, you absolutely need to track your expenses and budget. I mean, I can't stress that enough. I mean, I've been doing that, for as long as I can remember, but it's really an important aspect of it. And, here's another fun stat, or because I always like to throw these in, but, only half of Canadians actually have a budget. So yeah, it's one of these surveys that, Statistics Canada throws out, and really only half. And then that really shocked me, actually. I just thought maybe a bit more would have that, but really only one in two people. But, going back to budgeting, I mean, regardless if you do spreadsheets or, old school of maybe writing it down or what have you, you have to track those expenses. And it's not just because you already know what you're spending, but you need to get a sense of, what are you spending on for one, what's increasing, what's decreasing, where can you, cut back, where areas of improvement, surprises, and so forth. I mean, at the end of the day, you've got to treat your finances like a mini company. Like every company in the world has a budget. I mean, there's no company to get away with just saying gut feeling and then reporting to their management team or board of directors that everything's fine. So I think you should view yourself as almost a mini company. And in all seriousness as well, that's the only way I think personally you're going to meet your financial goals. Otherwise, you're just sort of guessing again, right? So I think I do it on a spreadsheet. I think that's it doesn't have to be complicated as long as you're tracking and you get a sense of what's actually happening. I think that's key. You can always use other software programs that are out there. There's plenty. But I like those old school ways of doing it. And I think you simply have to do that. Otherwise, it's just hard to meet a goal when you don't write stuff down.
I agree. I think whatever you pick, whether it's the simplest spreadsheet or app, don't complicate it. Pick the simplest thing and just kind of get started. Later on, if you need to go more advanced as you're getting into things, or you have more stuff going on with your investment, you can kind of go more advanced. But I think the simplest thing is start simple, and then you can kind of go from there. Don't try to look for the most complicated thing that has all these things. You get kind of scared and you don't end up doing anything with it.
That's right. That's right.
The biggest thing. All right. So another, question I had for you, and I think this is something we were a little bit hinting at earlier, is fees. Fees are that hidden monster that we often don't see, hear, or even think about when deciding, thinking about maybe an investment or a fund. But what should we be looking at when it comes to kind of fees, and in the long run, do fees really matter that much?
Yeah, well, fees are absolutely 100% an important aspect of in investing. I think we've all heard of the power of compounding, right? Compounded interests in terms of making returns. Well, fees are often have the effect of negative compounding, and so they eat into your returns. So you have to be absolutely aware of what fees you're paying on the investment products that you buy or that you own. We all have to pay some sort of fee at the end of the day. Nothing's free. And so, when you're analyzing, two similar products, you should always try to pick the one with the lower cost. I mean, that would make sense, just to keep more money in your pocketbook. But, maybe an example might help. And just to kind of put things into context, when you're always talking about, say, mutual fund fees or what have your investment fee products, they're often kind of just a couple percent per se, right? Like 2%. And if something is 1% less or 1% more, you might not seem that big of a deal, right? Like if you said that your whatever gallon of milk was going up 1% at the grocery store, it probably wouldn't be a big deal for you. You'd probably just kind of eat and go and then be on your way. But when you're looking at fees or investment management fees of that regard, compounded over long periods of time, it does actually add up to quite a bit. And so I wanted to maybe just kind of run through a quick math.
Yeah.
Nothing too painful, I promise, but it would kind of give people some context,
Absolutely.
So say you, and these are just going to be round numbers. Everyone's situation is different, but say you were investing 5,000 a year, that basically equates to just a little over 400 a month, for context. So $5,000 a year. And say on average, it returns 8% per year. And you did this for 40 years, right? And let's just say that investment product that you own charged a 2% fee. So after 40 years and earning 8% and paying that 2% fee, your investment would have grown to $800,000. So you might say, well, that's not bad, right? Like 800,000 is a pretty sizable amount, for a long period of time, and which is true. That's great. But what if I said, we found a similar product that paid a 0.5% fee? So really 1.5% fee difference. Everything else is the same. You're still doing the 5,000 a year, still doing the 8% over 40 years. What do you think that would be after, 40 years? Do you have a sense?
Wow. I couldn't even guess.
Yeah.
I mean,
it's a much.
Yeah.
Well, you could harbor a guess.
Well, I would hope it would be a few $100,000 more.
Yeah. It's a lot larger. It's actually $1.2 million.
Wow.
So that's a $400,000 difference
That's
just on a
half.
half
That's half
percent
the money.
difference. Yeah.
And that's
Yeah.
and that's half. Yeah, that's half of the 800,000.
That's right. That's right. So it's significant. So when you're, 400,000, I don't know about you, but that's a lot of money.
Not
And
pocket
you could
change.
probably, yeah, you could probably do a lot of that with 400,000. So again, like when you're looking at investment products and say, well, this one only costs maybe 0.5% more, 1% more, 1.5% more, what have you. Just remember, compounded over many years, that could add up to a lot. So the key point here is, I mean, fees are absolutely important, and you should always try to find, low fee product, because it's real dollars at the end of the day.
And I think when we see these new products that are not from the banks anymore, like the Quest trades and those things like that, well, simple, they're really trying to hit that message home. They're
That's
really
right.
trying to hit on
Yeah.
that message to people that, hey, like you're not seeing what's happening under the hood here. And so you don't
That,
actually realize that, from just because it is easy, right? It's your bank. You say, well, it's my bank. I already got my, my savings and stuff there, my checking account. So it's all kind of in one. So it's easy to kind of, and the banks know that too. Say, hey, you got all your stuff here. Why don't you just do this here? Right?
yeah,
It's all in
that's
one, it's
right.
all in one area. Easy. You don't have to worry about different logins and different accounts and transferring, but that you're not seeing what again, the hidden cost of that maybe little convenience that you're maybe getting of being all in one. You're not seeing what the actual cost of that is going to be for you, decades
Yeah.
later.
No, that's an important thing. I mean, and that's also cost with the commissions, right? A lot of banks still are charging commissions on single stock trades or ETFs and so forth.
Mm.
And, to your point, if you went to, the Wealthsimples or Quest Trades or the other brokerage houses, some of them have $0
Yep.
commission trades now. And so again, more savings. It might not seem like a much if you're, paying whatever $7 a transaction or $10 a transaction. It does all add up at the end of the day, particularly the more transactions you do. So yeah, it's another good point.
It's a good point. Yeah. And going back to this one, and maybe it's would have been good to bring up first, actually, when we hear this word, ETF. So we have the individual stocks, but you have ETFs and these broad market indices. What are these? And comparing them to individual stocks, are they better than just, doing stock picking long term?
Yeah, so this is a big topic about investing, but something I definitely love to talk about. So maybe first thing would just maybe to unpack and define some of those terms, so people are aware. You know, stocks. I mean, I think a lot of people are familiar with buying a stock or a share in a specific company, and you see that trading on an exchange, right? So that's single securities stocks, but and then indexes you mentioned. Indexes are the broader markets, right? Like the TSX in Canada, S&P in the US. These are big, broad indexes. ETFs in general, ETF stand for exchange traded funds. And so, probably the best way to almost explain it is, they're similar to mutual funds in a lot of ways, right? So mutual funds are basically investment vehicles where they have, you buy a fund, they've got several securities on it, you pay a fee on that. You go, banks sell these things. ETFs are basically identical to mutual funds, except they trade on an exchange. So just like owning that mutual fund, but now it trades in exchange. And what that means is the prices move up and down, just like you were buying that stock that you owned. So you could see it real time, what the value of it is, and it trades exactly like a stock. So during trading hours, and that's how you would transact it. ETFs in general, though, they actually mirror a lot of the passive, or what I call the indexes out there. So you can buy an ETF that would get you the performance of the TSX in Canada here, or the S&P 500 in the US. ETFs are, very popular for creating these index type vehicles, allowing you to gain exposure to that whole market just by buying one security versus buying the several hundred that are actually in that index in itself. And so, ETFs are really, I guess, easy, low cost, and simple way to gain access and exposure to the markets.
Is it a fair, I guess, analogy or example to think of if you had a book, like a physical book, and one chapter is like buying a stock, and like an index fund is like buying like the whole book itself, like you're buying all the chapters?
That's right. That's right. That's a great way to look at it. I mean, you are buying an ETF. You can buy that whole thing the entire book, if you will, and gain exposure versus buying every single page of that book or chapter of that book. I think that would make it much easier. So that is a good way to think about ETFs. And they can mimic a lot of different things. It doesn't have to be just the broad stock markets. There's a lot of ETFs as well that say mimic the entire technology sector or the energy sector or what have you. I mean, the products are almost endless out there. I mean, there are, I think I was looking at this, 10,000 different ETFs, whether you want sectors, commodities, geographies, what have you, it's there.
It's a lot. And that leads me to the next thing, exactly what you need is like diversification, right? Because you can really, there's so much you can go in and maybe tell us a little about diversification. And is it better to, when we talk about just investing like that, what are some good strategies? Is it better to maybe just invest, let's say in your home country? Should you kind of be looking at all the world markets? Should you be looking at just like, different ones for like technology and think like, how does someone kind of go about thinking about when they think about diversifying their, portfolio?
Yeah. So diversification is another important concept of investing, just like analyzing fees are. I think diversification is right up there as well. It's better to hold a lot of things in your portfolio because you never know when something's going to go down or something's going to go up. Obviously if you held one security, you're going to be at the whims of that one security or stock or bond or what have you, versus if you held, 20, 30, 40, 50 different things, well, then at least you're going to be isolated if something in a portfolio went south. So diversification is absolutely key to meeting your financial goals, whether that's short-term or long-term. So I think that's like point number one. In terms of, I guess, the home country, I mean, I think you see a lot of that home country bias per se. I think people are just familiar, living in the country that they're living in, they're investing in those securities. There's nothing wrong about that per se. It's just something that happens because you hear about those same, stocks or companies or ETFs. You end up buying those things. I would just maybe comment on the fact that, if you look at Canada in general, and this is just kind of equity markets, but Canadian's equity market is only really 2 to 3% of the global equity market. Canada is actually quite small in the world, where the US is really the largest market in the world, well over, I want to say it, obviously prices change, but it's 55, potentially at 60% in some points in time, right? So I always say it's about half of the global stock market is the US stock market. So that's one thing to consider when you're just say investing in Canada. The other thing to point out in investing in Canada is we're a commodity country in general, right? We're a net exporter of commodities. Obviously energy is a big focus in mining and so forth. And so Canada is really at the whims of energy prices. Even if you're not investing in energy companies per se, a lot of the banks do lend to these, and so there's always an inherent weight toward commodities and energy in general. So something that you want to be cognizant of as well. And then just overall diversification, I would say, my recommendation is always to be invested across asset classes, whether that's bonds or equities, geographies, many different countries and sectors. I think that's a better way to build a truly diversified portfolio versus maybe just focusing in one area or the other. So at the end of the day, owning more is better than owning less.
I think when I first started reading, I'm trying to think, I think it's funny, I bought the book, many years back, several years back, but I don't think I really read it properly. It was called Millionaire Teacher. That was the book. And it was just about someone who was a regular school teacher, Canadian, but he wasn't actually teaching. He was teaching overseas in like Singapore or something like that. So he didn't even have like a pension. And he was literally, so he'd written a book about everything he had kind of learned, and he talked about how frugal he was. And he said, like, I don't really recommend going as extreme as me, where it was like literally like turning the heat on and off depending on how much I wanted to save. He was going very extreme. Like his parents would come over and they'd say, it's a little bit cold in the house. Like, no, it's fine. Temperature's fine in the house. And so he would, but he kind of distilled his knowledge of like, and that's where I first, he talked about, you've got to be in, you look at the Canadian market, look at the US market, look at, developing countries overseas, look at emerging markets and the Brazils, India, China, look at those markets. And you kind of want to have a slice of all of those kind of in your pie, along with bonds. And we can talk about that later, but you want to kind of have a slice of kind of all these ones. You're kind of explaining that and talking about that. And that's where I first got the exposure of like, okay, well, there is a home country bias. And I think it's funny, if you're in Canada, then naturally you'll think, yeah, Canada, we always think of the US. If you're in the US, maybe you probably don't think of Canada too much, because like you mentioned, it's such a small amount. If you live in the US, you probably think of more of US, probably developed emerging, and other stuff, you
Yes.
probably don't think of Canada in that sense. But if you're in Canada, you probably naturally think, well, I live in this country. It makes sense to maybe have a small sliver for my home country as well, because you know that. And then you have the
Yes.
rest of them. But that's where I got that, I guess, that realization from. And then when I read another book about, it was I Will Teach You to Be Rich. There's a chapter again later on that talks about investing, and I think it was I don't know if it was called Swenson model, or I don't know if it was called that. It was someone who was like at Yale or someone like that, and he had like this. He grew the fund amount to like an extraordinary amount. He had his certain allocation, and he had the same type of allocation. He had like a U.S. one, he had a developed one, he had an emerging one, he had a bond one, and then some other ones from there. But that's where I first kind of saw that from. And I think it's a lot of times I think people are thinking about individual stocks, things like that. And that's sometimes it's a little bit of a narrow type of thing. You're just thinking about one stock, but you're not thinking about the whole basket that you might kind of be missing.
That's right. That's right. And I think it's at the end of the day, yeah, whether you're doing it on stocks alone, I mean, make sure you own a lot. But again, you can get that whole exposure through just buying a single ETF or even just a few ETFs. So again, just the more the better. I think that's really the key at the end of the day, because they just help reduce the overall risk in the portfolio. I think that's the big key word as well, right? Diversification is going to lower your overall risk, and that's going to help you meet your goals at the end of the day.
Yeah, and I think it'll also help you. It'll make you feel a little bit better about it, because again, and I think it goes back to what you said. Everyone has to kind of identify like what their risk tolerance is. So you have to know, hey, if you're not really comfortable, like if this type of thing really scares you, then for sure stocks, probably individual picking is not going to be good, because you're going to kind of live and die with how the market kind of takes it. And especially these days, since 2020, like the way things are, things are up and down. Right now we're in like a pseudo bear market type of thing, and I think people can get a little bit, it can scare you. So if that type of thing, you can't really deal with that well, then that may not be the thing for you. So you have to kind of know your risk tolerance, and kind of find something that kind of fits into what you are comfortable with, and something that doesn't get you every day kind of looking and kind of panicking.
Yeah, agreed.
And I think the next part I was going to say is like, the websites, and this is, I think, the part that makes it tough, I think sometimes, is websites and online news. They like to promote the hot new stock, the latest IPO coming, and it's going to be really big, this and that. And I guess I want to pose this question to you: is what's the danger of this type of information for a newbie investor? And we talked about, should newbie investors really ever consider picking individual stocks versus these ETFs we've been talking about?
Yeah, so there's I guess a couple questions there. I mean, it's almost like should people be listening to a lot of stuff you hear on maybe Reddit or Twitter and so forth, and should they be a stock picker? I guess the first part of that is, I mean, you have to be very wary of what's actually out there. I mean, I know there's, in the day of social media, everything's accessible, right? You can read about things coming at you from all different types of directions. But the reality is you don't know who that person is ultimately, why they're saying that, what qualifications they have to say that, and what incentives. So there's a lot of unknowns. And again, it's almost like that flex culture that you talked about. It just, saying something right then and there just to get a reaction or getting likes or votes and so forth. It's not exactly financial advice. So I would be very wary about that. That's not to say that it's all bad out there. There's obviously people that are trying to do a good job, but it's hard to sift through all that. So just be cautious when you're, utilizing social media as your core. Well, I guess I wouldn't even advise that. It shouldn't be your core educational source at all. It should just be something that, you're just aware of, right? So that's one thing. And then I guess, the other, and actually even before I get going for that, because this whole social media thing of people, getting rich on, crypto or Bitcoin or the meme stocks too, I think you mentioned. I mean, we also have to remember that, these stories, some people might be millionaires off of these investments, and they might go all in on something and not diversify, and that person might be rich off of it. That's not to say that they didn't do it that way, right? But for every one person that does that, there might be hundreds, if not thousands, that didn't do it or lose all their money, and you don't hear about those stories because Twitter and the other bunch of social media platforms aren't really going to promote that, right? They're going to promote the thing that's in style. And I think the key point with investing, you got to remember that investing is a zero-sum game. So if you're making money, someone else isn't. It's not like everyone can be all collectively making money, right?
Right.
So I think that's something that not everyone can be a millionaire. It's a zero-sum game. It's as simple as that. So you want to, really understand that component. The your second question on should people pick stocks? I got nothing against picking stocks. I mean, picking stocks is fun. I think a lot of people like talking about that, with their group of friends or dinner parties and so forth. I would say just make sure you're doing your research on that if you wanted to go down that path. You also want to hold a diversified portfolio, right? But it's also a lot harder when you're looking at 10, 20, 30, 40, and 50 stocks. I mean, that's a lot of work for somebody. And so if you're new to it, you might want to just come in and buy an ETF instead. That might probably save you a lot of anguish and headaches and risk down the road. Not to say that you shouldn't ever do it. I mean, I think you should just look at your portfolio and say, hey, well, maybe with the core amount of money that I want to save for, say, retirement or a down payment on a house or what have you, I'm going to put it more into ETFs. And then for that portion of the portfolio where I want to take more flyers and more bets on the next hot thing, maybe you can do a little bit of that. I think the key point is just kind of understanding what you're going to be putting into your portfolio and understanding the bets that you're taking.
Absolutely. I think it really depends also. It's on that person. Like if there's someone who's very interested and excited about, reading financial reports, looking at numbers, earning reports, like they really want to do that deeper dive, then picking stocks, potentially might be okay for them because they actually want to go, they're excited by that type of thing. Like numbers excite them. But if you're just someone who almost kind of wants to, we'll call it set it and forget it type of a thing, that may not be the one for you. You might want to just go with the broad market funds, the ETFs, and just kind of cover a lot of eggs and just have a big basket and kind of be able to check that, maybe it's a couple of times a year or once, whatever your cadence is, but you're not really actively checking. If you want to be someone who's kind of in the weeds, those people, they're probably checking things more often. They're keeping track, they're buying and selling. So if that's not really you, then you may want to stay kind of away from that. And the other side is if you do want to feel a little bit of, it's interesting to say like the more articles you read about this type of thing, they're going to say like, honestly, this type of thing is the most successful people. It's actually the most boringest type of thing. You're just buying ETFs, you're holding long-term, you're just kind of buying more and more and just letting it kind of grow over time. So if you really feel like you need like a thrill or something in life and you feel like you have to do it, maybe you decide on your own personal risk, what's that percent allocation, whether it's 5% or 10%. And I just want this amount to be just for stocks. You can kind of maybe play in that kind of space a little bit and set yourself.
Yeah.
If that, again, it all depends on the person, but they could pick a limit for themselves and say, hey, you know what? I can't have my more than 5 or 10% of my portfolio being individual stocks. And, if things kind of go off, I'm not in terrible danger.
Right. And you make a good point there of, picking names. I mean, a lot of people pick names because they also want to make money, but they're trying to beat the market per se. Mm-hmm. Individual investors want to do that, but also professional, active money managers are trying to do that as well. They're always trying to beat an index. But again, this almost goes back to ETF investing, and people have to realize like the numbers that are out there, and that active investing in the long term is unable to actually beat the market. There was Vanguard, which is a massive ETF provider. They've done many studies on it. It was just one I read recently, but there's been many articles written on this, whether, can active managers actually outperform? And the short answer is no. And if you look at the stats, it's quite staggering. I mean, this Vanguard studies, and this was all across all disciplines, global US equities, Australian equities, UK equities, and so forth, essentially all global equities and bonds as well. Over the course of 15 years, which is more of a long-term time horizon, because on a given year, things obviously you could beat the market on a 1-year basis, but we're investing for the long term. Over the course of 15 years, it was the numbers were anywhere from 70 to 80% of active managers were unable to beat their respective indexes.
Wow.
So that's that's a big number. And remember, you're paying these active managers, whether it's 1% or 2% or 3% fees for that period of time to underperform, and that's going to again eat into your returns. So, I mean, those are just facts and numbers that are out there, right? I mean, that's just the reality. The market is hard to beat the overall market, and so if those numbers are already against you, why not just pick the passive ETF, hold on to it, and then you'll be better off.
Right. So when we go back to when we talk about mutual funds, essentially that's what you just said. That's kind of what's happening. We have essentially the mutual fund looks like what you're saying is there's a fund manager who's essentially taking your mutual fund and they're kind of picking and choosing individual stocks and they're trying to see if they can beat the market, and they seem to not be able to. And regardless, they're just taking their high fees.
That's right. That's right. And again, it's almost something that's, out of sight, out of mind,
Right.
because you are paying those fees every year in, year out, regardless of
Regardless.
what's happening, right? It's a percentage of what you've invested in, but they don't send you a bill. It's not like you go to the grocery store, the
You don't
hardware store,
see
you
it.
get a bill. You don't see it. It just gets netted off your amounts. And so, maybe because you don't see it, you're not as aware, but you have to be aware that it's just being netted off.
Is
They've already
that
taken it and it's gone.
is that done on purpose or by design, that we don't want you to get a statement to see blanket how much we really took from you? And it's just kind of like it may come in your overall statements of general fees, but we don't really want to make it as explicit as possible. Is that done on purpose? You
Well,
ever get to see
I don't,
that?
I don't know if it's done on purpose per se. I mean, it's been like this for the longest time, and I mean, ETFs are no different, but at least ETFs have the low fees. But everything is just netted off, so you just have to be aware, and then you got to be aware of all the other fees, right? There might be admin fees and other types of fees. It is, to your point, it is broken down in the statements, but I just think people sometimes, because they don't get that bill, if you will,
Right.
they're
Yeah.
not as aware, right? It's not like paying your
Your monthly,
Netflix bill, or your utility bill or something like that.
you don't get that note. Yeah, you get your, like, you see it on your statement saying, oh, it's going off there. You don't really, like, you don't see it regularly. That comes maybe quarterly or every couple of months. It's not something you may spend as much time looking
That's
at.
right.
So it's almost like it's like paying someone to throw a dart and completely miss the dartboard. You're paying them to miss the dartboard completely.
Yeah,
And just
and I think
and
they've
not,
done studies as well on that as well. Could we do random darts at a board, and would that fund outperform a professional money manager? And I think that random dartboard actually does quite well.
yeah.
So
And it's, given where we are today, I mean, with the high volatility of the markets and over these last few years, it's been an up and down time. What are some of the strategies maybe investors, especially the newer ones, who are, again, probably a little bit scared when they get started and all of a sudden they see these maybe losses right away? What are some strategies they can use to maybe limit the negative impact of their portfolio, whether that's maybe bonds or something else? We talked a little bit about diversification, but are there other strategies that they can kind of, maybe look at?
yeah, I think you know, diversification is absolutely key, because again, it can weather the storm, right? Generally, equities and bonds, their correlation patterns, or the fact that they're negatively correlated, help in a portfolio over the long term. Some people like to put in other assets like commodities and real assets and infrastructure and so forth. I mean, all of that is under the concept of diversification, because over the long term, that portfolio's got a better chance of surviving and meeting any financial goals that you do have. So I think that's one thing. I think the other thing is just, it almost kind of goes back to basics. People are investing, and they should have a financial goal of why they're investing that money to begin with, right? Not just investing just to talk about investing. I mean, oftentimes people are investing because they're saving for retirement, or buying or down payment on a house, or maybe it's for a vacation, or for children's education fund. All those are different goals, and all those are going to have different time horizons. And so I think helping define that is going to help people, better define their investment strategies and what they own in the markets, because you can get really whipsawed about all the news that you see every day. Are interest rates going to be going up or down? Where's inflation going to settle at? Should I buy this new stock? Or and I know that's can be overwhelming. So I think it's helpful just to kind of define that, and then that way, at least if you have a goal in mind, you can stay the course over the course of the long term. If you stay in there long enough, things are generally much better for you. And it's just, I mean, you just look at the stock. I mean, look, here's another stat. Like, I think the S&P 500 over the course of 100 years, on average, right? On average, returns something like over 9%. I can't remember the exact number, but I believe it's over 9%. That's on
Hmm.
average. I know some years it can go up 30%, some years it would be down 20%.
Yeah.
But if you held it for 100 years on average, you're compounding at 9%. So
Hmm.
I think that's not bad
It's not bad. And
at
it's
all.
actually, and I think you made a great point. I think it really does come down to what your goals are. That's probably one of the first questions you get asked, even if it's through the bank or any fund, that they want to kind of know, hey, like, what are maybe, if you're going to see someone for help or guidance, that's one of the first questions they ask you, because they're going to ask you, like, do you need this money soon, in the next year, 5 years or so? If you do, doesn't mean they're not going to invest it, but, like, you may not want to put all of it in, or you may not want to have a very risky type of portfolio, right? You may want a little bit of a balanced portfolio, right? And we can talk about that. But if
Yeah.
you're going to be, hey, I don't really need to, this is money I consider I don't need to see for 10, 15, 20 plus years like that, then you're gonna kind of just gonna go and you'll ride the waves, knowing that, hey, I know things are bad now, but I don't really, I'm not dependent on that money today.
That's right.
I really need it in 20 years. I hope at that time it's obviously it would suck for someone who maybe was ready to cash out soon, and you've seen all this happen. It is an unfortunate type of thing. It's in no one's control. But you kind of touched on this, the concept of, timing the market versus time in the market.
Yeah. Yeah. I mean, it's such an important topic. And I think I've said that about a few of these things, but between those two, it's all about time in the market. It's not about time in the market. Time in the market is extremely difficult. We just talked about the stats of active managers who are trying to time the market. They've shown to underperform over the long term. It's really timing the market to allow compounding to work for you, and it's significant. I mean, again, there's many of these studies about just being in the marketplace, and I want to share one with you because I was reading this, I think, just on the weekend as well. But they did this study on the S&P 500, and I believe it was a bunch of companies have done this, but I think this was by Putnam in Boston. But essentially, just imagine again, and they took a period of 15 years, right? 15 years in the S&P 500. If you had started with $10,000 15 years ago and just simply invested, like what we said, just had buy and hold, the S&P compounded at 10.6%, and so you would have ended up with $45,000 at the end of 15 years. And so that's not a bad number, right? But if you were trying to time the market, because, during the last 15 years, there have been up and downs. We had the global financial crisis. We've had, COVID and so forth. Say you were trying to time the market and somehow, you bought and sold on days. But let's say you don't know when the good days are and you don't know when the bad days are. And so let's just say you missed the 10 best days in those 15 years. Just the 10 best days, just because that same $10,000 would be $20,000. So 5% return. So you still made some money, but you could see it's literally half the money. Just so by simply being in the market and not worrying about the ups and downs, you would have 45,000. And if you're trying to time it and you missed the 10 best days, you'd be down to 20,000. I mean, that's just significant. And so again, at the end of the day, time in the market.
I think, that's the one constant thing I've heard is timing the market and being, and just, being able to, historically, it's, if you read the, the studies and about the markets and the history of the markets going up and down, historically, the markets have still gone down. They've always kind of gone up, and people have kind of, who have stayed with, have kind of rode that kind of wave up. The ones, it's the panic moves where people make when if they don't maybe know enough or don't have that awareness, that panic when things drop and they drop out, and then they pull out, and then when the market kind of turns and goes up, you kind of miss that wave, that upward swing.
That's right.
You missed it, right? Because you were just focused on, okay, I'm already losing money, I don't want to lose anymore, let me pull it out. And unfortunately, also what happens is, if you've, again, it's unfortunate if you have a bad experience sometimes and you don't have as much, I guess, knowledge, you just maybe were dipping your hands in, but you weren't going in as confidently, knowing about timing the market, compounding. That may also unfortunately just turn you off from investing again after an experience like that, because you said, let me try it, I had a really bad experience, I lost $5,000, I'm never doing that again. And for the rest of your life, you may never invest. You had such a bad experience, but you didn't maybe have some of that more, I guess, base financial literacy, kind of like knowledge about how the markets kind of work. And spending time in the market to realize that, hey, if I don't need this money right now, this is okay. I'm going to likely make this back up and more over a longer period of time.
Yeah. And especially if you're buying the broad-based indices. I mean, there's one thing to say if you were just had a single security and you kept with it, then that'd be something else. But if you were at a broad-based ETF index, I mean, you should hang in, I guess is the key conclusion at the end of the day.
I think as much as whenever you can or often as you can, just kind of keep on buying. Like if you've bought these broad market indices, like let's just use the US one, because you gave the stat about it's more than half of the world's markets. Just if someone just could only buy one fund and say, you know what, I just want the full US market, you'd want to just kind of keep on buying that, right? You want to kind of keep on putting money in and let that grow, get your shares, your individual shares that just kind of keep on growing and let that kind of grow over time, right? Whatever you can, whether it's, mentioned whether it's 5,000, whether it's 500, whether it's 50, whether it's 5, like whatever you can get, you want to kind of put into it and just kind of keep on buying, right? That's the magic, is just kind of keep on, putting money, whatever you can, into it, and just kind of keep buying and holding,
That's right.
long term. I think most people talk about any kind of wealth, whatever that is, even if it's, real estate, which is its own kind of beast, it's, it's the buy and hold. It's the things you buy and you hold them for a long period of time. Right?
Yeah.
Yes, people can do the flipping right away and doing this, or the crypto one and do that. You can do that, absolutely, and you can make quick money off that. But you can also lose quick, right? If you can get it quick, you can lose it quick. That's kind of the analogy for that one. So what about taxable accounts? I think that can be a little bit confusing. We talked about TFSAs. For Canadians, that's going to be our type of account. What's the difference between the taxable accounts and maybe non-taxable accounts, and maybe why does that matter?
Yeah, again, I think taxes obviously are important. I mean, we all pay taxes, and so trying to understand the differences between non-taxable and taxable accounts is key. I think an easy rule of thumb to kind of decipher all this is, TFSAs and RSPs, they're considered, effectively non-taxable accounts for all intents and purposes. The tax-free savings account, anything you put in there is simply tax-free, right? There's always a limit that the government allows you to put each year. And so anything you generate there, 100% tax-free. The RRSP, you get a tax credit. So anytime you contribute to that, you're lowering your current tax bill. And then when you retire and withdraw that money out, then you will be paying taxes. But the benefit is presumably you're probably going to be in a lower tax bracket because, if you're not working anymore, you probably don't have any income and you're going to be in a lower tax bracket. So you're just deferring your taxes. And I think, you want to be maximizing your TFSA and your RSP when you're saving, especially early on. Non-taxable accounts or non-registered accounts, they're just like the regular investment accounts that you could set up as well. So any returns that you get in there are going to be subject to your marginal tax rate. And, again, you should try to maximize your TFSA and RSP before, putting money into a taxable or a non-registered account.
Right. That makes a lot of sense. And for those who are, if someone listening from the US, the equivalent would be the 401k for your RSP. And is it Roth IRA? Is that the equivalent for TFSA in the US?
Yeah, I believe so. I mean, I'm not an expert on those ones, but I believe those are the ones you want to be focused on. Yeah,
you'd basically want to maximize those first. And then if you still have more money at disposal after, then you'd look into putting them into taxable accounts from there. You can open up a regular account and you can put them there. But yeah, you want to maximize the tax-free accounts first.
Yeah,
that makes perfect sense. So continuing what we were talking about, when should someone start thinking about retirement saving, and how should they go about doing this? Whether it's opening up a RSP account or there's other type of things, employer matching. How should they be thinking about that process?
Yeah, so retirement, saving in general, I think the key here is like the sooner you start thinking and investing for retirement, the better. Because the magic of a compound is going to take effect, which I think we've talked about at length here. When you think about just retirement, I think there's probably a couple avenues. If you're working for a company, they often have these employer matching programs or group RSPs programs, and those are quite lucrative because for every the companies will set up programs where the employee they'll contribute anywhere from I've seen anywhere from 3 to 6 to 8%, and the employer will match that actual amount. So say you're putting in 5% of your paycheck, the employer will match that, and that becomes your pension or your RSP. And so that's a really powerful way to start saving because you're effectively getting that return from your employer, but at the same time that amount is being invested in whatever securities or funds that they have set up. So I would say that'd be a key thing to take advantage of, right away or as soon as possible, and try to max that out because you can start building up your retirement. The other one is to set up the RSP for a couple of reasons. For one, obviously, if you don't have an employer-sponsored plan, you should have your own RSP and build your own retirement program through that. But at the same time, that RSP also serves as a vehicle that you own. So anytime, say, you leave an employer, that money that you've generated in those group RSP programs can be put into your own personal RSP. Because people are leaving companies all the time and moving to different opportunities. So it's good to have these things set up just to kind of start saving for retirement. And again, you're getting that tax credit if you do set up that RSP. So I would say those are the couple, key points that I would talk to you about retirement saving.
I remember when I was working my corporate job in one of the bigger companies, enterprise software company. When I first signed up, the manager first came and said, we have an employee RSP matching program, and you should definitely do it. And I think they said you could put up to like 13% of yours, but the company matched up to 4%. Like you could put 13, so you could put up to your like amount. There was a certain amount you could keep putting out, but like they said, they'll match up to 4 though. They'd match up to 4% of it, which is kind of around par what you were saying, that 4 to 6. Some might go higher than that. And she said it's basically free money. And I was like, yeah, sure. And I did it soon after, but like that's the type of thing. Yeah, like once you start at a new place, or if they have that type of thing, like you want to get that set up right away. Like you don't want months to kind of go by and say, oh yeah, I'll do it. I'm kind of really busy, kind of working. Like that should be like in your early first few days. Usually when you start a company, it's onboarding anyway. It's onboarding.
That's right.
They're getting you actually have time. That's the time where you want to get that stuff. So you want to make sure that first check kind of comes in right away, right?
Yes.
You don't want to miss any paycheck, right? You want to ask them, hey, how fast can this be set up? Should be like your first call, right? So it's free money, and you want to take advantage of that. And you're right. When you go, you can move that money with you, and you can, there are different places you can kind of put that, but you can kind of, move that along as you kind of go into your career. And the other area, and this is something I'm trying to think when, again, I probably, this was in the Millionaire Teacher book, but again, because I didn't read that book carefully, I was kind of skimming the first time around, and I was looking, and the author in that book basically said, and he's, they're, I think in the US now, but he said he basically, for his wife, he had this thing set up, it was called a target date fund. And he said it's a Vanguard fund, and it kind of was an all-in-one. And it was perfect. And I was reading it, I was like, like, okay, like I know where my RSP is. It's in a mutual fund, I think. But I don't know what this thing is. And then I read it in another book years later, and a person saying that I loved, and he kept saying, I love target date funds. He said it so many times. He said, can you guys tell by now that I love target date funds? And I was wondering if you could maybe tell us a little bit, like, what are target date funds, and why would someone consider this type of fund for their retirement?
Yeah, so target date funds are another security that's offered out there, and that's what we do here at Evermore Capital. Is we're doing target date fund ETFs for the masses, so everyone can retire comfortably and easily in Canada. But what exactly is a target date fund? So we talked about kind of these group RSP plans, and a lot of times these companies, when the employer matches it, you'll be in a target date fund. And they're actually excellent retirement vehicles, all for a low cost. So what are they, I guess, is the key question. So I'll try to explain this as best I can. Target date funds are effectively like balance funds. And what balance funds are like, they're like your typical funds that you would see. And I think you hear about them from the banks, whether there's 60% equity or 40% fixed income, or some of them might be a 70-30 split, or some might be a 20-80 or 50-50 or what have you. There's a lot of these different balance fund splits, and they all correspond to a different, risk tolerance and level. So target date funds basically take those balance funds, with the key difference being that allocation, so say that 60-40 or that 50-50 or 70-30, they change over the course of time, and they change as you approach and through to your target retirement date. So I think the easiest way to explain it is almost an example. And so say early on in your life, say you're 30 years away from retirement, you buy a target date fund. That target date fund is going to probably be invested heavily in equities, 95% or maybe 100%. And the reason for that is, you got a long time horizon until retirement. So you can withstand the volatility of the risk of having lots of equities. But at the same time, equities are a growth asset. They're allowed you to increase your principal, your capital for retirement. And then as you go through the years, 5 years in, 10 years in, and as you get closer to retirement, that equities weight, it starts to fall, and then the fixed income weight starts to rise. And again, the reason for that should make sense. As you near retirement, you want to de-risk, you want to lower the risk. You don't have to take on that much equity risk, right? You want to preserve the nest egg or the capital that you've built up. And that you do that with increasing your bond weights because they're less riskier than equities. And bonds also start to pay out coupons and so forth. And so they follow what they call that changing of assets and weights. That's called the glide path in target date funds. And so the key thing with target date funds is you don't even have to do that rebalancing. The target date fund in itself does that for you. So you can go off and do what you need to do in your life and spend more time doing the things you want to do than trying to rebalance your portfolio. The target date fund, it automatically does that for you, and it follows the date that you want to retire. So when you're looking at target date funds or looking to buy them, you just simply pick the target date fund with the year in that fund. So, if you wanted to retire in 2045, you would pick a target date fund with the 2045 marker in it, or the one closest to it. So it's as simple as that. Yeah, it's really the ultimate set it and forget it solution.
I was just going to say, yeah, it seems like it's you just look at your age. When do you, anticipate, you want to retire, whether you're 20, 30, 40, 50, whatever the case is, pick that year fund that you potentially want to retire in. And obviously the further away it is, it's going to be highly skewed towards equities, which, as you said, makes sense because you've got a long horizon. You want that growth potential. And as you kind of slide across to the right side, you want to switch over to a little bit of safety of bonds and those type of things where your risk is a little bit less because you're closer to, I guess, cashing out, and you essentially you're setting it and forgetting it, and you can kind of move on with your life. You don't have to worry about did my US economy asset allocation go off? Is it, if I had 30% there, it's now 25, I got to rebalance. Everything is kind of taken care of it for you. You just kind of enjoy your life and find other ways to make money, or just enjoy your life and do whatever you want to do.
That's right. That's exactly what it is. I mean, it's trying to make investing as simple as possible and as painless as possible for people, because not everyone wants to sit there reading about the markets and figuring out what to rebalance to this asset class to that, but everyone still has to save for retirement. And so this is almost that it really is that solution for retirement is the target date fund. It's in our minds, that's why Evermore brought it to the market, because we saw a gap where retirement needs. We're not being fully met with the investment products that are out there. I mean, you have those typical balance funds there or single funds, but the problem is nothing that's completely all inclusive. And this serves that purpose. And again, kind of going back to that company example, if you were lucky enough to work for one of these companies with these targeted funds and those group pension plans, then that's fantastic. But a lot of Canadians didn't have access to that. And so what we're trying to do is bring that concept and that product to the masses, so everybody can have access to target date funds.
Yeah, and one of the things you and I talked about was, and this is like, while you're still with the company, if they're inside a target date fund, if a Sun Life or someone has that product, it is an affordable product to have while you're with them. The moment you get out and you're just solo taking care of it yourself, it's a significant difference in fees.
That's right.
Very significant difference in fees. And I can just share my story quickly. It's basically, I was looking at, once I read about the target date funds in those books, I scoured, obviously I looked for, the Vanguards, and there's, Vanguard, BlackRock, these are the two ones. And I scoured to look, okay, well, I'm sure Canada must have one here. And I sent emails, sent calls, and they just said, no, we don't have that here. Like, unfortunately, it's not here. It's not in your country. And so I was kind of stuck with the provider I was with. And then when I Googled up the fees and looked at the PDF, I was like, wait a minute. I looked at my bracket and I was like, wow, this is a lot. But again, I really wanted a target date fund. So I was with them for a period of time. But as I mentioned to you personally, when I talked with you, like, I Googled around, talked to some people, more intelligent people who were more savvy investors. And then that's where they kind of mentioned Evermore. And that's where I kind of found you from. And when I looked at the products and I looked at the fees, and there was a huge, significant difference in those fees. And again, when it goes back to that calculation you gave in the beginning, is like, well, look at the rough, you could be potentially leaving, and no one knows what the future is. You could potentially be leaving, several hundreds of $1,000s on the table that just went to fees for a similar return that you would have gotten.
Yeah.
Right? And it does make a big difference. And so to me personally, I'm not someone who really actively likes to check individual stocks, and I'm not going to wake up and check different markets or things like that. That's not really, I love doing this stuff now, as in like the investing part of it, but I'm not someone who wants to look at individual things like that. So for me, a set it and forget it type of thing works very well, because I've done enough research to know that these are good funds. They're broad market funds. It's a long-term game. and it's going to be balanced for me, and it's working for me as I kind of go. My job is just to kind of keep feeding it as much as I can.
Correct. Yeah.
That's basically what it is. So that's a fantastic vehicle for people who might want to be looking into setting up their retirement fund. And the other one, which is another interesting one, and one that I have used as well, and this is kind of how I started it. It seemed like the most non-threatening way, from my perspective, when I started, were these robo advisors. They've become very popular, last 5 to 8 years. I don't know when they started, like exactly when, but at least the last 5 to 8 years or plus, they've kind of been around. And maybe you could tell us a little bit, what is a robo advisor, and who would be a good fit for maybe that type of investing strategy?
Yeah. So robo advisors, they're effectively online, investment platforms or software where, you sign up with whatever provider is doing the robo advising. You answer, several questions about your return expectations, risk tolerance, and what have you. Actually, a lot of reality is no different than when you go into a bank branch and the advisor gets you to fill out a questionnaire, similar along those lines. But you do this online, and then it spits out effectively the types of investments that would be suited based on the answers that you've given. And so you don't talk to anyone. It's just software online that you just do this, and then they would comprise a portfolio for you. So the benefit is it's much cheaper because there's no person to talk to. There's no portfolio manager per se. It spits out funds that you could possibly buy in or investments, and then off you go. And so it's kind of a way to, that maybe a first step into do-it-yourself investing. The one thing though that I would note with that is, it's good, but at the same time, you're going to have to also monitor these investments as well, because, over the course of time, your life is going to change. I mean, someone who's 25 filling out a robo-advisor platform is probably going to have a very different risk return profile when they're 40 or when they're 50 and so forth, right? Because, things change in your life. So it's something you still have to monitor going forward, but it is definitely, a cheaper alternative than the traditional financial advisor bank branch type models.
So essentially what you're saying is basically, yeah, like if you're a certain age and you set a more aggressive growth type of one, they're not going to be coming back and saying, hey, you seem to be, you're 20 years older now. Do you want to consider? It's just going to be set probably in a setting that you probably do, that they might do it for you for the first time. You'll have to probably go and manually and make that or request that change for your risk tolerance. If you don't do that, it would just kind of assume you want to be as aggressive as you were when you were in your 20s or 30s.
That's right. You would be stuck, most likely stuck with that, right? Yeah.
Right. So you want to manually go and say, hey, look, I'm 50 now. What I did, 10 years ago was good, but now I kind of want to scale down to maybe closer, whether it's a 50-50, 60-40, whatever it is for you, based on when you might be wanting that money. You'll have to make that manual adjustment, and also keep track of how it's doing, to see that you are happy with it.
That's right. And then depending again on the platform, it might, you don't know what suite of products. You're gonna have to also do research there. So there's a bit more, I think it's a good first step into do-it-yourself investing, but there's still other nuances that you're going to have to still monitor. You can't just set it and forget it, right?
Yeah, it's not a pure set and forget. That was my first, I would say, for it. It started with mutual funds, which we talked about. Obviously, when you don't know the banks, just like they just naturally say, "Oh, put it in a mutual fund." I said, "Oh, fantastic." Okay, I felt good. I said, "Oh, my money is like." I felt good about it. I felt happy. I said, "Hey, I'm working, salary's going up, and it's being invested, and it's at the bank. This is fantastic. I'm doing the right thing." And you are, in theory, you are actually doing the right thing. It's just that it's not the most optimal solution.
Yeah.
There's a better solution out there where you could be keeping more of your money with you, basically, right? So there's nothing wrong with that. I felt good about it. And then once I found out about the robo one, I started with that, because again, my comfort level wasn't there. I didn't feel fully comfortable enough. I heard about ETFs and stuff like that, but again, knowing about it or hearing it is not the same as, okay, well, now go and get some. And so I didn't know. And I thought, what, this seems to be the next step for me to kind of do that. As I'm still learning, that seemed to be the next safest thing, that, hey, let me have something that's a little bit automated for me. And then as my comfort kind of went, you can make a decision from there. And so for those people who are maybe keen to go that do it yourself kind of investing path, what would you suggest that maybe they do when they're first maybe beginning their research?
Yeah, I mean, there's there's a lot of different avenues that you can go. I mean, I think you mentioned your path, was going down that robo advisor path, and that's definitely a good first step. I think maybe with a lot of people, the first thing you probably want to do is, again, identify those financial goals. And I think I've touched on that before in our questions, but you definitely really want to define that. What exactly are you investing for, right? Is it, again, retirement, buying a house, vacation, what have you? Because it starts to help define what you're trying to accomplish here, because that's going to be, those goals are going to all have different time horizons. You're going to have different risk tolerances and so forth. And so you want to, and it's okay to have many different goals going on at the same time. You just want to help define that so you can better manage that and start to understand how much you'll need or how much you want to set aside. So I think that'd be the first step. Robo-advisor is a great way. If you're not comfortable with that, you can always still go to the, bank branches to accumulate information. You don't have to, buy the mutual funds that they're selling, but that's a good way, just a first step if you've never even done that, just to understand what exactly is your risk and reward tolerances as well. If you're not comfortable with that, online, there are so many free resources now. I mean, a lot of the bank dealers have free resources. A lot of the independent investment firms have free resources. I mean, here at Evermore, our website's evermore.ca. We've got a lot of just free resources on differences of RSP, TFSAs, investing, and so forth. And so a lot of sites are free. You don't have to pay for any of that. And that's a great way to educate yourself on investing in different types of investment strategies and different securities and ETFs and so forth. So there's a plethora of information that's out there that you can kind of look at to kind of get started. There's just with the power of Google, you're going to find a lot of different things that are out there.
There's a lot, and it can be overwhelming sometimes as well. But yeah, if you just, even if you're doing simple searches as what is an ETF, what is an index fund, these type of things like that, just putting in simple questions like that, you'll find a lot of information. If you just do some Google searches on, investing platforms or in commission-free investing platforms, you're going to see ones that are going to show up there, whether that's the Wealthsimple, Questrade, or other ones like that. You're going to see a few of them. You can probably find sites that are going to compare a whole bunch of them, so you can do a little bit more of okay, well, what am I getting? What do I need? Which one gives me what I need? And looking at that from that point of view. Again, lots of books are out there, even online. The Canadian Couch Potatoes are a very popular site for a simplified. They have some simple model portfolios. I think CanadianPortfolioManager.com, they have a website, and there's a YouTube series with that as well. A lot of stuff there. Justin Bender, someone who I'd spoken with quite a while, and I probably bothered him many times to ask him questions, and gave me a lot of great advice. So it's, again, I think it's looking up the information, and also, asking people. There's no harm. And I do it all the time. It's like literally sending out emails. When I emailed you as well to talk about that, sometimes I'm asking you questions, and sometimes, hey, I know we're talking about these things, but do you know anything about this or any resources for this? It's just about asking questions. Right? Asking questions. Maybe they don't know, maybe someone else knows, maybe they know someone else who might know the answer. So just asking questions and kind of being, I think, curious is going to help you. And there's no shortage of books. I already mentioned a few. Millionaire Teacher, I Will Teach You to Be Rich. I think Tony Robbins has some good books. There are other ones, Walk Down Wall Street. There's some good books that just really talk about fundamentals. And if you read 2, 3, 4 of these books, you're going to see the pattern emerge very quickly. They're all going to say the same type of things. They're going to say, look, don't get excited by stocks. Look at these broad market funds, look at ETFs, and buy and hold them for a long period of time. It's not overly sexy. It's not the coolest thing. It's not going to be flexing and saying, hey guys, I just bought that US market index ETF yesterday. It's not the most exciting thing to talk about. But it's the one that really builds people wealth over the long period of time. There's no real the magic one. I think we all are looking for the magic pill where you take it and then you lose 10 pounds. There's no quick. I think it's the more I've learned, the quick fix stuff isn't really quick. It's the long game. I think that's the biggest
I think that's a really excellent point. I mean, investing is a long journey, right? It's a long-term, it's a marathon, not a sprint. I mean, a lot of this get rich quick schemes, they just don't work. Investing is not like that. And so, you should be cautious. Yeah.
And speaking of that, for maybe if they're, we've kind of been talking about with younger people, but if there are parents who are maybe listening, or, young parents who maybe want to teach their kids, maybe they know a little bit, if maybe they don't know too much, maybe they want to teach their kids about money investing. what advice maybe would you have? I guess a good question is like, what's a good age? At what age can kids when can you kind of set up an account for them? Is there like how young, like, can you have something set up for them where like you kind of manage it for them and then they can take it over? Or is there a certain age where you can set up an account for them? Like, what advice would you give for your parents for young kids who want to kind of get them started earlier?
Yeah, no, this is a great question. It's in the boat that I'm in. I've got two very young kids, and I started them as early as possible. And I think that was just basically how I was raised. I think earlier on we talked about just financial literacy and how we would get it, and then I got it from my parents early on. It wasn't from courses or books, and so I kind of have passed those teachings on as best I can. I mean, they're only kids at this point.
Yeah.
I can't teach them, but a lot of concepts we talked about today. But you can definitely start them early. I mean, you mentioned opening accounts. Well, you can open those accounts as soon as they're born and get them set up with an RESP, which is a registered education savings plan. And so if you contribute to that, the government matches 20% each year. And so again, that's money that you can take for your kids' education. And so I would recommend every parent set that up. And again, it's tax deferred until they go to school. And so it's a very powerful vehicle to start saving for their education. So that'd be one avenue to set that up right away. But in terms of like teaching them, I mean, it's funny. I was actually looking for books on this, but then I realized that I could probably just teach myself. And so there are definitely books on it. I scanned through them, but I never bought them because I think if they're just basic things like teaching them, to save money and understand what they're paying for things, they won't understand everything that you're telling them right now.
Yeah.
But I think you have to get them into that mindset early on in life, so that it becomes more intuitive later on when they start learning it for themselves. So again, I don't have any silver bullets or magic pills here. I think it's just a matter of just common sense things and teaching them, what things cost, how to say, the concept of saving in general, and just kind of keep working and building on it. I mean, that's how it was effective for me. And so I am effectively going to be doing the same thing with my own children.
I think you're right. I think it's small conversations, picking maybe one area, whether it is around saving or how money can kind of grow or like, you look at what age they're at, and as their maturity kind of grows, you can kind of add the next layer. You can add the next layer. You don't need to throw the whole, like, read this whole book, read this kid's version book of thing. They're not going to read it. They're probably not going to make much sense of it.
That's right.
It's like, it's going to be boring for them. It's like, I'm asking myself, I wasn't overly excited about this stuff, 10, 15 years ago, and I was a full, adult at that time. I can imagine, kid, I'm probably thinking about playing a game or with my friend, and you're giving me this book that's talking about like money and from my understanding is you're the parent, like you guys seem to be taking care of this. Like, it seems like my job is to kind of go to school and play with my friends. So
yes.
you have to kind of meet them where they are, I guess, right? And see, it's like, I think it's showing them in day-to-day things wherever you can when you're out with them, just mentioning things, just kind of putting it in their ear and like making them aware of these things, and looking at the cost of something, right? And
that's right.
And it's small things like that. And if you do those small habits, daily, weekly, monthly, yearly, over time, that knowledge is, I guess, going to say compounding for them.
It
right?
does. And it's yes, absolutely. And it is. It's just baby steps. It all adds up, and you'd be surprised how much you actually end up understanding and knowing after a course of time or many years. So
yeah, I think it just hits you over many years. It starts to make sense because your parents talked about the importance of saving money, investing it, growing it, that type of thing. And so you naturally think that way. And then when they're in their late teens, early 20s, they're kind of ready to hit the ground running, and they've already got something set up, and parents have likely been telling them, hey, whatever you're making, you got to put a certain amount into this, right? We had set this up for you. You're going to continue taking it over. Right.
That's right.
We've taught you enough that you can now fish it. You can now fish yourself now. And
that's right.
You're going to kind of keep building it, and you're lucky you got 40 plus years sort of go. You're in a great spot. And so that small steps like that is a great way. And I think I wanted to kind of say, for someone who maybe who's listening this and has never maybe thought about saving, investing, it can be an overwhelming process, right? We talked about there's a lot of things, it's what the banks are saying, what family and friends are saying, especially. I was telling you this story, we talked offline when we were talking about this doing this podcast, and I told you like that I was, running a capstone class for students, game students, and he was checking his phone. He was saying, oh, like the stock I bought is like going down or or just went up or down. I was like, oh, I was kind of laughing along too. And I was like, I don't even have a brokerage account, like my own solo one. Whatever I have is in like a mutual fund. And I was just like, so it can be tempting when you hear other people talking about this and you get excited. They say, oh, the stock market is going up, it's really high. And you get
Yeah.
excited. And you can get fooled into things. There was the whole I don't know too much about it, but there was the whole I think it was like the GameStop stock, like on the Reddit forums, and they were like, I don't know
Right.
if it's called, shortening the stock, but they were just they were building it up. They were inflating that stock and said, everyone just buy GameStop and let's inflate that stock.
Yeah.
And
Yeah.
so,
I do remember that.
and so some people probably did well too, but if you got in there or you didn't know what you were doing and maybe you got stuck or you timed it out badly, you could have lost a lot there, right? If
That's
you
right.
try to jump in on that, like, oh, this stock is really ballooning up, it was super cheap, let me jump in, and you somehow mistimed something, you might have lost, more than just your shirt on that one. So it can be a little bit overwhelming. And I think going back to what you said, that first thing is really just taking one thing that you maybe want to focus on, whether that's just financial literacy, and go. Actually, one book, I think I completely forgot this one. It's one book that a lot of people talk about. It's called Rich Dad Poor Dad by
Right.
Robert
Yeah.
Kiyosaki. That's one, a lot of it's been around forever, I think, maybe since the
Yeah.
90s. And I read that. And once I started reading and you got really, really into it, it's not that he's specifically telling you any specific thing that he's doing. He's telling you about the things he's doing, but all he stresses over and over again is financial literacy. He's like, when you learn, how about financial literacy, how kind of the game works, what the rules are, you make better decisions.
Yeah.
You're gonna see opportunities that other people miss because you have awareness of financial literacy. And that's, you have awareness, you can see opportunities kind of as they come. You won't necessarily miss good opportunities because your knowledge, you're learning kind of new things. And
Yes.
that was a very fascinating book. I think it just really kind of just gets you to focus on financial literacy and just kind of growing that knowledge. And so we've covered a lot today, so I know if it does sound overwhelming, I would really recommend, maybe go back, listen to the episode, pick one topic maybe that you just want to start with, and just do that, learn about that, read up on that, and then come back and do the other stuff. Don't try to do every little thing together, because again, it's just going to be too many things, and we don't want you really just kind of give up halfway through and
Yeah.
not do anything. Like, assess where you kind of are. I think Brian, you hit on the point many, many times, is like, look at what your kind of goals are for the next, long term, next 5, 10, 15, 20 years. Assess that, and then start to look at, well, based on that, what is it you want to do, and then start to do some research on there. There's no shortage of information out there. It's just a matter of kind of sifting through the noise a little bit. Unfortunately, it's the good and bad. You got a lot of stuff out there. You have to sometimes sift through a little bit of the noise as well sometimes.
Yeah. I'd say, for people looking for that advice, I know there is just so much information, to your point, Vishaal. There's just so much, and it can get frustrated and you end up not doing anything. And that's something we definitely want to avoid. So, for the people listening out there, I'd say, we talked about goals, but also keep it simple. There's so much information out there. You got to really kind of narrow down, what is it that you're trying to do? What is that goal? And let's just figure out how much you need to, set aside. And then you start researching on how much certain investments can return, and then you start to, slowly build at it. I'd say that's like, a big thing to do. Don't get swayed into buying this hot security or doing that or this. There's a lot of that.
There's a
The
lot
other
of
thing
that.
the other thing I would do is I would recommend people open up a direct investing account. You could just, those are free to open. You could simply open one up, then you'll have start to get access to just research and things of that nature. You don't have to invest just yet, but just opening one up to have that tool that's there, and you get familiar with the tool and resources. And again, that's going to be your foundation for investing as well, and to take charge of your own investing journey. And so, with that, then you just start spending a few hours each week or each month, whatever you have time for, comfortable doing, just reading about things. I mean, we talked about this earlier. There's just so much, when you're starting to Google things, best ETFs or how to, build a portfolio and so forth. There's a lot of credible sites that are out there, like the bank sites, the dealer sites. I mean, there's lots that you can really, dip your toe into.
I've done a lot of that.
Yeah.
I've done like just what you said, kind of like you say, if I was looking for a certain type, I want to say, best ETFs for XYZ, right?
Yeah.
There's so much out there. And again, you got to make sense of it yourself, but there's so much out there. Are there also, I know my uncle used to tell me about this one, like, can you open up, are there like those like play accounts where you can kind of like use play money and kind of like get your feet dabbled into the
Yeah,
process of using the brokerage account, and that can kind of help you maybe get your feet wet, but you're not really risking your own money yet?
that's right. That's right. I mean, yeah, I think that one of the bank dealers have it. I believe RBC had one where you could simulate trades, and so and it's exactly the same platform, except you could just simulate the trade just to get a feel, like when you're say putting a buy order or a sell order, and what limit orders are, and all these different terms, and it can become pretty daunting. But at least you can simulate it and test it out, and then see what it looks like, and then that's also a great way to learn versus doing it with real actual money. So
Yeah.
um, there's all these little things. They might not seem like much, but once you start to do it, you build your knowledge base up significantly, and then you'll be surprised how much over the course of time. And you can always go to the big ETF providers like the iShares or BlackRock, Vanguard. They've got a lot of resources online as well. I mean, there's just I can name a lot of them, and so there's just a lot out there, and probably no time to name every single one of them, but there's out there. You just have to keep reading and educating every single day, and then you'll get there, and you can take charge of your journey. I think, Vishaal, you're when you explain your journey to me in our initial conversations, I thought that's a great example of someone taking charge of things, and
Yeah.
understanding what they have to do.
You know what? It was just a matter of every day slivering and making. If you don't, you have to make time for it. I'd make time to
Yeah.
kind of sit down. I'd be on Google. I'd be looking at, different websites, different talks, blogs, things like that. Books. If I read and someone said, "Hey, this is a really good," I mentioned actually it's a good book. I'm looking at it now. I mentioned to Reboot Your Portfolio. Dan Bortolotti. I think he wrote that.
Yeah.
Canadian Couch Potato. That's a great book. He takes you through each chapter, kind of phase of like if you have nothing, like literally you have no brokerage account, it goes from chapter 1 to like 6, 7, whatever it's like 9, all the way to. He's not telling you which funds to do. That's not something they can really do, but they're talking you through the process of getting set up and how to think about it.
Yeah.
Right. So again, you might be able to find that stuff online. You absolutely probably can, but it's just a matter of spending time to do that. It doesn't mean you have to buy a book. It could be a video, a blog, but you just got to invest the time to kind of do that. And I told you when I first started, I had a whole bunch of things. I was doing I had ETFs for a bunch of different things, the world markets as well, but I had about maybe 32 or 33. I had a whole bunch, and they weren't bad. They had banks and different things, but I was like, oh, I feel like I just have too much. And
Yeah.
I just had to go simple. I just went down straight to the simple fundamental ones, the main world markets one and bonds. And then I may have had some individual stocks, 1 or 2 that I felt really good about, but that was it. I went from 30 something to 6. From in the span of a year, from maybe this May or so, I just kind of did that. And honestly, I just felt so much lighter and better. And I just felt like, hey, I'm not stretching myself. Then I want these to kind of grow. If I have too many of them, I can't give enough to any one fund. What am I going to give you? 10 here, 20 here? I want to be able to put more into these ones and the broader markets and let them grow. And so I would say, like you said, simple really is, there's happiness in simplicity.
Yeah, for sure. And then I think that's really the key. And it just kind of popped into my head. And actually, I know you had recommended a couple books, but just on mindset alone, I thought a couple ones that I actually read and was The Millionaire Next Door.
Oh,
I thought it just kind of it's not about investing per se, but it's just about the concepts of saving and frugality and so forth. I think that really helps get you into that mindset.
It's a mindset. And they say the average millionaire has maybe 5 to 7 income streams, right? It's they don't really just have, people think it's just their day job. And after watching a lot of these videos, and even last night, I realized I look at the people who are doing well, not just in my own circle of people I know, it's ownership. You have to have ownership of something. If you purchase Apple products, things like that, you need to own it. You need to have some ownership in Apple, right? You're essentially you're a part owner there. If you're people who have, if you really look at it, wealth and success building, you got to own stuff. You got to have ownership of something. You own your own business, or you own physical real estate, or you own stocks, investments. It's about ownership.
Yeah, right? It's definitely about ownership.
Otherwise you're a consumer. And again, nothing wrong with that, but a consumer means you're spending that money's going out. You have the potential for, liabilities and debt, right? If you're just a consumer, right?
Yeah.
You want to have ownership. You want to have ownership of something.
Yeah.
I think that's.
Yeah. And I think that just helps. I mean, I studied a lot of the financial concepts just in school in general, in CFA and Canadian Securities Institute and so forth. So a lot of my reading is spent on almost a lot of the mindset type books, or different different viewpoints. Like another one that kind of pops into my head is the psychology of money.
Yes, that's a very good one.
Yeah. So I thought that was a good one, just to kind of, put money in a different context in some ways. And so it just kind of just helps frame things. It's nothing in the book, for at least for me, was so groundbreaking. But again, it's a good read in trying to frame, your mind and about understanding about money and saving and investing and so forth. So
it's very important. It is a book that's very commonly recommended, and like I think that's a great one. So I'm glad you recommended that one. And you're right, it is a mindset one. And like I said, we've given a bunch of books and some websites and blogs here, and so hopefully this helps people kind of get started on that journey. And Brian, I want to thank you again so much for taking the time to talk about the importance of financial literacy, just investing foundations with everyone. I think for those looking to learn, for those who maybe want to learn more about what we talked about specific to target date funds, how can people find and kind of connect with you about that?
Sure. Yeah. I mean, people can go visit our website, www.evermore.ca. And we're also available on all the social media platforms at Evermore ETFs. And then feel free to drop us emails. Our information is there on our website. They can learn all about target date funds and investing in general. And so I would encourage everyone to check out the website.
Wonderful. So again, thank you everyone so much for tuning in. And we hope that you found this episode valuable. Make sure that you subscribe so that you don't miss a single episode, and rate and review, as it would mean so much to me. You can always find us across all platforms on YouTube, Apple Podcasts, Google Podcasts, Spotify, and Amazon Music. And we'll see you again soon.